Hi everyone, I'm Raisa Dokrat, and to start off this session, we'll be going through IAS 38. So this is the standard that covers intangible assets, a topic which you guys are already familiar with. Now, for reference purposes, you will need the IFRS standard IAS 38, as well as your textbook chapter 6. So today in this session, we are aiming to learn how to identify an intangible asset. And once we've identified it, we then want to know how does it get recognized in our statement of financial position, right? So remember, just like we have our other assets, property, plant and equipment, investment property, financial assets, inventories, intangible asset, once we are able to recognize it, sits there on our statement of financial position as an asset category. Okay, so it is a topic that's very important to businesses. It's very important to the users of financial statements. Now, there are different ways of acquiring an intangible asset, and we will be looking at some of these ways in detail in this session. For intangible assets, it's also very important that we are able to identify the assets with a finite useful life versus the assets with an indefinite useful life, right? And when we go through this section, you'll see why it's important and how it actually affects the measurement of the intangible asset. And as with any accounting topic, once we know that we can recognize something in the financial statements, we need to know how do we disclose it in our financial statements, okay? So IAS 38 is here to prescribe the accounting treatment for intangible assets that are not dealt with specifically in another standard. So on the next slide, I have some of the exclusions. For example, if the asset is already covered by inventory, then you would deal with it and account for it under IAS 2 rather than IAS 38. So basically, it makes sense if an asset is held by an entity for sale in the ordinary course of the business, even if it's an intangible asset. So the business, their ordinary activities is selling an intangible asset. This logically would fall under IAS 2, and you would use the principles under IAS 2 to account for this asset. So as long as the asset doesn't fall under any of these other asset topics, we can then go and implement IAS 38. Some of the intangible asset terms that you would already be familiar with would be brand names, trademarks, research and development costs, customer lists that you would have even come across now in business combination. So let's start with the obvious. What is a tangible asset? A tangible asset is something that you can touch. It has a physical presence. It's a type of asset that is real, one that we can sell or we can exchange for money. For example, a factory building or equipment, machinery. If the business was going bankrupt, we could take these tangible assets of our company and we could easily sell it off in exchange for money and then go and pay off our debt, right? That's easy to sell off. But on the other hand, we get assets that have no physical presence. So think of it as an invisible asset. We refer to these as intangible assets. For example, Nike, a brand that you are all familiar with, it's a renowned brand. They are able to sell their products at a higher price than an ordinary no-name brand tacky. People generally will equate the brand name with a good reputation, a high standard of quality, and basically like a certain standard or quality of lifestyle. However, from the company's perspective, whilst it's easy for us to put a monetary value on tangible assets, the value of a brand name is a difficult one to grasp. So, how do you put a monetary value on your good reputation? Now, IAS 38 is the standard that helps us to understand what intangible assets are, what are the rules to account for intangible assets. And paragraph 8 of the standard defines the intangible asset. So it's an identifiable, non-monetary asset without physical substance. We know that an asset is a resource controlled by an entity. Now, on this point, I want you to bear in mind that although the definition and the recognition criteria of an asset has been updated in the conceptual framework, it doesn't override the definition and recognition criteria in this IFRS standard. So remember, your conceptual framework is there, but it is not an IFRS standard itself. So the definition of an asset as per IAS 38 is the one that we will make reference to for this topic. Now let's analyze each of the criteria that relates to this definition. So in order for us to identify that something is an intangible asset, we must be able to say that it is identifiable. And an asset is identifiable if it is either separable, meaning that it is capable of being separated or divided from the entity and sold off separately or rented or exchanged, aside from selling off the whole business or the whole entity. And the second point is that it arises from contractual or other legal rights. So, for example, Nike can license its tick mark to third parties who want to benefit from Nike's reputation. For example, a towel company can pay a license fee to rent Nike's trademark and use it on their product. And then obviously that will attract more people because they want to be walking around with a towel that has a Nike tick mark on it versus a plain towel. Okay? The second aspect of the definition is non-monetary, which is relatively straightforward. Monetary refers to money. Non-monetary refers to any asset that is not money or money that will be received from a debtor. And the third aspect is without physical substance. So remember, I mentioned, think of it as an invisible asset, one that we cannot touch. It has no physical presence, unlike a motor vehicle, unlike a building. Okay? Now, when we look at the definition of an asset, one of the biggest aspects is control. And if you are able to get future economic benefits from the use of the asset, and at the same time, you are able to prevent others from getting those benefits, then you have control of the asset. In most cases, you control an intangible asset when you have the legal rights to it. So, for example, you bought the license or you signed the contract that gives you control over that intangible asset. But sometimes control is achieved in a different way. For example, you develop a great software internally. Now you've developed the software, so you control the sales of that software. Now, in other cases, you may not really be able to demonstrate that you have full control over the asset. And if that's the case, you can't recognize it. So in order for you to be able to recognize the intangible asset, all of these aspects must be met. So the definition as well as the criteria. Okay? A typical example of a situation where you can't fully control the asset would be, for example, if you have a qualified employee in your business. So the asset is not the physical human being, obviously, right? The person who shows up in flesh at work. The asset to the company is the employee's ability and the employee's skills that are used at work. So if that employee left work, you can't replace them with any random human being off the street. You obviously need someone with the same skills as the employee who left work. So since we cannot touch the abilities and the skills of that employee, you would think of it as an intangible asset, the value of that employee's skills. Now, although the company can earn a future economic benefit from the abilities of the employee, the company doesn't own them. And regardless of what the company invested in training that employee, the skills ultimately belong to that person and not to the company. So human resources of a company, we can't say that we fully control it, and we cannot demonstrate the control over it, so it cannot be recognized as an intangible asset. Now, the point noted about the treatment of an asset that has both tangible and intangible elements would be a situation where the entity has to use judgment to assess which element is more significant. For example, if we have computer software, software is not a physical asset. We can't touch the software, okay? It's something that's stored on a computer disk, right? Or you can load software onto a USB, something physical. But what's more valuable, the software that is on that USB or the USB itself? So this is just a very basic example of something that can have both a tangible and intangible element. But the business world, it would require the entity to use its judgment and to provide its reasoning for which element is more significant. So we've gone through the definition, and once we meet that definition, we need to move on to the recognition criteria. Because an intangible asset must be recognized if and only if both the recognition criteria are met. The first one is that it is probable that future economic benefits that are attributable to the asset will flow to the entity, and the cost of the asset can be measured reliably. So the second one is pretty straightforward. If you can't measure the cost reliably, then you cannot capitalize the intangible asset. So capitalize means we must go and now recognize it as an asset and show it on our statement of financial position. But if we don't know at what cost or what value to put it there, then we cannot. So the cost of an asset must be measured reliably. Then with regards to future economic benefit, future economic benefits can either increase its revenue or decrease the expenses. Either way you look at it, the future economic benefits has the potential to increase the company's profit. So the probability of future economic benefits must be based on reasonable and supportable assumptions about conditions that will exist over the life of the asset. If the intangible asset doesn't meet both the definition and the recognition criteria as an intangible asset, then IAS 38 says it cannot be capitalized, but rather any expenditure on this item must be expensed to our statement of profit or loss. So we expense the expenditure as and when it is incurred. Now, intangible assets are initially measured at cost. Just like we said, we need to be able to measure the cost reliably in order to recognize the intangible assets. And any costs incurred after the intangible asset is in working condition, for example, the initial operating losses, are then expensed in the profit or loss. We're going to go through the measurement in more detail shortly when we start discussing the different ways of acquiring an intangible asset. And with regards to the subsequent measurement, so after we have brought in the intangible asset, then we need to remember, as just discussed, that the recognition criteria still needs to be satisfied. And the intangible asset will be measured at the cost, less accumulated amortization, and less any impairment losses. But we're going to cover the amortization and impairment losses in detail shortly. So like I mentioned at the start, there are different ways for a company to acquire an intangible asset. So the separate acquisition of an intangible asset and an internally generated intangible asset, you probably covered already, right? Then we have intangible assets acquired by way of a business combination, and this we cover when we're doing IFRS 3. Then finally, we have intangible assets that are acquired by way of a government grant, as well as exchanges of intangible assets. With these last two, we don't go into in much detail. And what we focus on in this session is the separate acquisition of an intangible asset, as well as our internally generated intangible asset. So let's start with the first one, the separate acquisition of an intangible asset. Now, the probability recognition criteria is always considered to be satisfied for intangible assets that are acquired separately. So remember, we said that it must be probable that future economic benefits that are attributable to the asset will flow to the entity. If this wasn't the case, we would not have acquired it in the first place, right? So for an intangible asset that was acquired separately, the probability recognition criteria will always be considered as met. The second aspect is that the cost must be measured reliably. And if you're purchasing it separately, so you're purchasing from a third party, obviously there's going to be an amount that you're purchasing it for. So you can measure that cost reliably. This cost will take into account the purchase price and include any import duties, non-refundable taxes, but it will also exclude any discounts and rebates. And it will also take into account any directly attributable costs. So legal costs, for example, right? It will exclude costs of introducing a new product or costs of businesses in new locations with new customers, and it will exclude any admin costs. And once the asset reaches the necessary condition to be used, all the initial costs are stopped or ceased. Okay? So if we look at example 6.1 from our textbook, let's turn to that example. I Wanted Limited acquired the Coca-Cola brand name from the Coca-Cola Corporation for 2,000. The purchase price is to be settled in 4 equal advanced annual installments of 500 each. The first installment was paid on 1 Jan 2005. The discount rate is 10% per annum. And the required wants us to determine whether or not I Wanted Limited can raise the Coca-Cola brand name in its statement of financial position. So this clearly relates to an intangible asset that was separately acquired. It's not part of a business combination. It's not internally generated, right? I Wanted acquired the Coca-Cola brand name from Coca-Cola Corporation. So they purchased from a third party, okay? It even tells us the amount that it's purchased at. So basically, the amount was paid to Coca-Cola, who's our third party, and we purchased this brand name. And we know that this means that the probability recognition criteria is always considered to be satisfied, okay, because it is a separately acquired intangible asset. The cost can also be measured reliably because we are told exactly how the payment will be made for the brand name. So it told us 500 for equal annual installments. And as the payment will not be made once or upfront, we then need to take into account the discounting factor. So here it's simple present valuing on your financial calculator because they're telling us that the payment will be deferred, right? So the payment for the asset will be beyond the normal terms. The second way of acquiring an intangible asset would be through a business combination. So this falls under IFRS 3. And if an intangible asset is acquired in a business combination, the cost of that intangible asset is its fair value at the acquisition date. So just refresh your mind from IFRS 3. At acquisition date, you take the assets into account at fair value. It's in line with your IFRS 3 knowledge. You already know that you measure all the assets and liabilities at acquisition date at fair value. Now, if an asset is acquired in a business combination, is separable, or it arises from contractual or other legal rights, sufficient information exists to measure reliably the fair value of the asset, then we are able to say that yes, this is an intangible asset acquired through a business combination. And in accordance with IFRS 3, the acquirer or the person or the business purchasing recognizes at acquisition date separately from goodwill an intangible asset that they purchased from the acquiree, irrespective of whether the asset had been recognized by the acquiree before the business combination. So maybe in their separate financial statements, it wasn't recognized as an asset. Okay, but now under the business combination, if we meet the criteria, then as the acquirer, we can recognize the asset separately from goodwill as an intangible asset. Now, the probability and the reliable measurement criteria are also considered to always be met in this instance because of the fact that the company or the acquirer did actually buy the assets of the other company, and those assets include this intangible asset, which means that they did pay a cost for it, right? So we can measure the cost reliably, and the probability of future economic benefits, we purchased it, they were able to sell it to another company. So the fact that we purchased it or the acquirer purchased it shows us that there is a probability of future economic benefit. Okay? And then again, with regards to the measurement, as I just mentioned, it has to be in line with IFRS 3 at the fair value at acquisition date. Now, if the intangible asset is recognized as part of the business combination and it was an in-process research intangible asset, meaning that it was still in the research phase, then for subsequent measurement, we expense the costs if it's still in the research phase and if the development criteria are now met. So if the criteria are met, then any development costs are added to the carrying amount of the intangible asset. But whilst it's still under the research phase, those costs are expensed, which we will be going into more detail when we're doing internally generated intangible assets. The next one was internally generated goodwill. Okay, so goodwill is a term that you are familiar with, again, under IFRS 3, and you can only recognize the goodwill acquired in a business combination, but that is different from the goodwill we're talking about here. So internally generated goodwill is not recognized as an asset because it is not an identifiable resource, meaning that it's not separable. It doesn't arise from any contractual or legal rights. And because it's not separable and it's not an identifiable resource that's controlled by the entity that can be measured reliably. Right? So the rule here that you just need to remember is that internally generated goodwill, so not goodwill from a business combination. We're talking about internally generated goodwill. We can never capitalize it or recognize it as an intangible asset. Now, here's an important one, right? One of the ways of acquiring an intangible asset, and it is one of the most important ones. It relates to internally generated intangible assets. So what happens when you actually develop the intangible asset yourself? Now, it's a bit more complex and a little bit tricky, and that's why IAS 38 gave us specific guidance on how to account for internally generated intangible assets. So to assess whether an internally generated intangible asset meets the criteria for recognition, an entity classifies the generation or the creation of that asset into two different phases. One would be the research phase, and the other would be the development phase. So you can't all of a sudden get an idea, click your finger, and then the asset appears. Okay, there's a process that needs to be followed. And the start of it is what we refer to as the research phase. It's the investigation that you undertake to acquire or to get the information, the knowledge, the understanding before you can actually go and develop or create the asset. For example, you are evaluating different alternatives for your new software product. So no intangible asset has yet been created from the research phase, you are just studying in this phase. You don't have any asset at this point. You haven't even started working on the asset. You are basically just gathering the information, the knowledge, the understanding. So any expenditure on the research must be recognized as an expense when it is incurred. So as and when you are incurring those expenses, they will go to your expenses in your statement of profit or loss. And this makes sense because sometimes you have a good idea or you have what you think is a good idea. And then as you start gaining knowledge about it and you start figuring out, okay, my idea seemed good, but it's honestly not practical to put together, or it's too costly and I don't have the resources. And then you scrap the idea completely. So just like, I mean, in everyday life, you start something and it ends before completing it. Okay. Now, it wouldn't be fair to capitalize this because at the end of the day, we don't have an asset yet. We might never have an asset to show for it. So at this point, we can't recognize any of these costs towards an asset, but rather in this phase where we are still researching, it would go as an expense to our statement of profit or loss. Okay, so whatever expense you've incurred, you would say debit the expense in the statement of profit or loss and credit the creditor or credit your bank or however you're paying for that expense. The next phase would be our development phase. So development usually happens after the research phase is complete. And at the end of the development phase, what we expect is that you actually plan or design the new product, materials or processes or whatever it is. So before we start selling the product or using the product, we complete our development phase. Now, it's important to distinguish between the development phase and the research phase because, yes, you can capitalize the expenditures for development now that you're actually working on producing the asset. So it's not so straightforward because IAS 38 gives us 6 criteria before we can capitalize these expenditures, right? And you're fortunate that you will have your standard with you. So this is an extract from your standard, and it will guide you if you had a discussion question where you needed to determine whether the costs could be capitalized or not, whether something was in the research phase or the development phase, whether it meets the criteria of being capitalized. So this 6 criteria has to be met. You have to be able to demonstrate that the asset will generate the future economic benefit. Now, the intangible asset arising from development is recognized if and only if each of the entities can demonstrate all 6 criteria are met. Now, you'll flag this in your standard, but also try to understand what they mean so that when you're reading your scenario in a test or exam, it immediately clicks in your mind that, okay, this means that we are meeting technical feasibility criteria, right? So in your scenario, it's not going to tell you that the development phase is met because the technical feasibility was met, okay? Or the intention to complete it was met, or the ability to use the intangible asset was there, or that we have the resources for it, okay? So what the question or the scenario will tell you is basically that we have industry experts at our disposal to continue with this research until the end or to continue with the development until the end. We have received a grant or a loan which will ensure that we have the financial resources to see this asset through. So what you are determining from that scenario is how to apply those words to the criteria that's in IAS 38. The reverse can also apply, where it can be told to you that although they are in the development phase, the managing director is a bit concerned as we had the industry expert resign with immediate effect. So that's going to tell us that, hey, maybe we don't have adequate technical resources in place. Okay, so when you're reading a scenario, you need to pick up both the the positive or the negative aspect of it and see how it's relating to what is in the standard. So in some instances, you may achieve half a mark for copying out of the standard, but the bulk of your mark will be there because you are applying what's in the scenario to what you have learned from the criteria in the standard that's given to you. Okay, so to quickly go through the criteria, the first one is that you must be able to show how the intangible asset will generate probable future economic benefit. Then we must show that the entity has an intention to complete the intangible asset, whether they're going to use it or whether they're going to sell it, but they must have the intention to complete it. So, for example, if they tell you that they're working on creating or developing this intangible asset, however, their key staff members are going on leave for 6 months, they may or may not return after that. It doesn't sound promising, So it must be clear that they have the intention to complete it. There must also be an ability to either use or sell the asset. So we can't just have a great idea, develop the asset, and then keep it parked up in our warehouse. We must have a plan or purpose of how we're going to use or sell the asset. The technical feasibility must be there to complete the asset, and all the expenditures that go towards this development must be measured reliably throughout this development phase. So once we meet these 6 criteria, any expenditure that we then incur during this phase is included in the capitalized cost of the intangible asset. So after the research phase, once we're in the development phase and we achieve these 6 criteria, we then capitalize all those to the cost of the intangible asset. And this takes place until the intangible asset is ready for use. So once it is ready for use, then we can stop capitalizing these costs. Now, we have here the revaluation of intangible assets. But remember that you probably would have discussed under property, plant, and equipment, or by looking at the cycle guidelines, that the revaluation of depreciable assets is actually excluded from the scope. At most, it would be at an awareness level, but I think it's excluded from the scope. And therefore, we don't need to go into it in detail, even with regards to intangible assets. So you don't need to go through the number crunching of the revaluation model, right? But for intangible assets in particular, I think we can make logical sense here because the revaluation model is not really popular anyway. If we were to carry out or to carry the intangible asset under the revaluation model, so sorry, like I was saying, if we were to carry the intangible asset under the revaluation model, we would need to reliably measure the fair value with reference to an active market. And intangible assets don't generally have active markets or markets where there are a lot of invested buyers and sellers. It's basically not easy to just go and buy and sell intangible assets, as we discussed at the start, right? So if there's no active market, then how will we measure this fair value? And if we can't do that, then how would we account for it under the revaluation model? So it's not the model that is selected by companies because it makes no sense where there's no active market to select the revaluation model as the measurement for intangible assets. Okay, so if there's no active market, then we measure intangible assets under the cost model, right? So there is an example, a very basic example in the textbook, but like I said, since this is not something that is included for testing, just get a brief understanding of it and don't go too in depth into anything regarding the revaluation model of our depreciable asset. Now, just like with property, plant, and equipment, where we have brought it into use, we have measured it, and then what do we do to this property, plant, and equipment on most likely an annual basis? So as we're using the property, plant, and equipment, we depreciate it. And that's how the carrying value of that property, plant, and equipment decreases year on year. Because obviously an asset can never stay or retain the same value as day one. Now, similar to that, we have amortization of an intangible asset. Okay, and this is done over the useful life of the intangible asset. But here, for IAS 38, you are required to decide about how much to amortize or what is the depreciable amount. So, for example, cost less the residual value. How long to amortize it for. So, what is the useful life of the asset? And how to amortize it or what amortization method you apply. But there's one specific thing about the amortization, right? And the specific thing relates to the useful life of the intangible asset. So it's very important upfront that you decide whether it has a finite useful life or an indefinite useful life. For an intangible asset, it can be either or. So if it's a finite useful life, in this case, you can estimate the life of the asset upfront. For example, if it was software, so the software would last on your computer for a period of 1 year, right? And then it will expire. So what is that lifespan of that software? 1 year. So it's finite useful life. You can put a number of years to that asset. The next one is an indefinite useful life. So for an indefinite useful life, there is no foreseeable limit to the period over which the asset will generate cash flows. For example, brand, right? It doesn't get used up in any way. We can, use that brand name for years and years and years, and it can continue. And I mean, in real life, we see examples of that. For example, the Coca-Cola brand. It's been around for years and years and years, right? So if we assess the intangible asset and we find that it has a finite useful life or that the length of the useful life can be established and we establish it, right? Then the depreciable amount of the intangible asset must be allocated on a systematic basis over its useful life. So just like how we depreciate over the straight line method, what we're saying is that amortization must begin when the asset is available for use, when it's in the location and condition necessary for it to be capable of operating in the manner intended by management. Now, these are the key words that you must be able to identify from your scenario. So your scenario will tell you the date that management began using an asset. Or it might tell you that the asset was brought into use in this location and in the condition necessary for it to be used. So you must then immediately think, why are they giving me this information? They're giving me this information because this is the date that amortization of that asset begins. Then just like with depreciation, amortization stops or ceases at the date that the asset is derecognized. So for example, if we then go and classify the asset as held for sale, then amortization must stop at that date. And just like depreciation, any amortization that we recognize annually goes to our statement of profit or loss. So it's an expense. It's decreasing the value of our intangible asset. If the value of an asset is decreasing, in order to do that, the journal entry that we would process would say credit intangible asset. What that also means is that in the carrying amount of the asset in my statement of financial position, I now have a minus amortization amount. And in my statement of profit or loss, I have an increasing expense. So amortization is being recognized as an expense. And if I were to do the journal entry, I would say debit amortization, the intangible asset, right? So as you are studying, as you are attempting tutorial questions or past questions, don't close up your mind to only doing what is in front of you. Think about your calculation, think about your journal entry, think about your presentation in your financial statements. If you do this, then whether the scenario and the question or required asks you to draw up an extract of the financial statements, or to draw up your journal entries, or to discuss how to account for something, you'll be able to answer any way of testing. Okay? So something as simple as amortization, think of how it affects my different statements. What would my journal entry be? Why am I amortizing? What date do I start amortizing? What date do I end amortization? Right? Then with regards to our residual value, the residual value of an intangible asset with a finite useful life, we basically assume that it is zero unless there is a commitment by a third party to purchase the asset at the end of the useful life, or there is an active market for the asset, right? Now, in both those cases, if it's like the example of the software that we gave, where we said that that's our intangible asset with a finite useful life because the software expires within 1 year, who would purchase that after the 1 year period, right? It doesn't really make sense. The second one we already discussed on the previous slide with regards to revaluation, that generally there is no active market. Okay, so this would show us that more often than not, we assume the residual value is zero. So if it's not even given to you in your scenario, don't worry about it. When you can calculating the carrying amount, it would be your cost less your amortization and any impairment. Okay, you can assume the residual value is zero unless stated otherwise. Then we move on to an intangible asset with an indefinite useful life. And these intangible assets, because they don't get used up, right? If you're not using up the asset, it's not deteriorating, it's not depleting in any way, then there's no need to amortize that asset. Okay, it's staying, it's holding its value. So that's why it's important to identify whether an intangible asset has a finite useful life or an indefinite useful life. Because if there's no foreseeable limit to the period over which the asset can be used, and it's just like, expected to generate cash flows throughout time, then we do not need to amortize it. We do not need to decrease the value of that asset ever, right? But if this is the case, what IAS 38 does require is for, in line with IAS 36, impairment of assets, that the intangible asset is tested for impairment on an annual basis. Okay, so how we do that is the entity is required to test the intangible asset for impairment by comparing the recoverable amount with its carrying amount. Okay, and this has to be done annually at least, or whenever there's an indication that the intangible asset may be impaired. So for example, if we tested for impairment every year on the 30th of June, but at the end of Feb, there was an indication that this intangible asset needs to be impaired, it's not worth so much anymore, then you also need to conduct the impairment test in line with IAS 36. So the useful life of an intangible asset that is not being amortized must also be reviewed each period to determine whether there's any changes in the events or any changes in circumstances, and now it's no longer an indefinite useful life assessment, right? So maybe now we realize that, okay, we thought it's going to last forever, but actually it seems that it will only last us another 3 years, right? So this assessment needs to be done periodically as well, reviewed at each period. Now, if we look at example 6.6 of our textbook, on 1 Jan 2001, Tipsy Breweries Limited acquired by way of a separate acquisition the Laugh Lager brand from Drunk Breweries Limited, right, at a cash cost of 200 million. Tipsy Breweries has accounted for the Laugh Lager brand as an indefinite useful life intangible asset. However, early in 2006, Due to a ban on the advertising of alcohol scheduled to take place with effect from 1 Jan 2008, Tipsy Breweries reclassified the brand as a finite useful life intangible asset and computed its recoverable amount at 150 million, with a remaining useful life of 10 years with no residual value. And they've asked us to prepare the journal entries to record the Laugh Lager brand for the year ended 31 December 2006. So remember, we said that if there's an indication of impairment, we must then go and test for impairment. And how do we test for impairment? By comparing the carrying amount with its recoverable amount. So it told us that the carrying amount was 200 million, but now the recoverable amount is sitting at 150 million. Okay, so it's lower than the carrying amount by 50 million, which means we need to decrease the value of the asset. How do we decrease the value of an asset? We credit the asset. So credit the intangible asset statement of financial position with 50 million and debit our expense. What is our expense in this case? It's an impairment because we are impairing the carrying value. So debit our statement of profit or loss with 50 million. Now, because we have put a lifespan onto this asset, we also need to then account for amortization. It's a finite useful life asset now, right? So to recognize the amortization, we're going to start with what is now our recoverable amount. And it tells us that it has a remaining useful life of 10 years. So that 150 million is going to be written off over a 10-year period. So we're going to debit amortization, statement of profit or loss, because it's an increase in an expense. And we're going to credit accumulated amortization in our statement of financial position, right? So that's also a decrease to the carrying amount of the intangible asset. And the amount is our recoverable amount, or our amount that the asset is worth now, divided by the remaining useful life of that asset, which in this case is 10 years. So we get 15 million as our amortization for the period. Okay, so we're going to get to the disclosure of intangible assets shortly, but this brings us to the end of the bulk of intangible assets and the key points of intangible assets. I just want to take you guys back to when we were talking about our internally generated intangible assets. And I said that this is actually one of the key aspects of IAS 38, where the standard spends some time discussing research, discussing development, discussing the criteria to be met for the development expenses to be capitalized, right? And we will be going through examples in class. But at this point, the example in your textbook that deals with this, and it's very basic for your level, but it's 6.3, okay? So for 6.3, they basically have given us different projects. So project 1, 2, 3, 4, and 5. And they've given us different expenses for each of these projects. And we then need to identify whether something falls under the research phase or the development phase. Okay? So like I told you, when you are faced with any question, you want to think about how you would answer it, whether it was a discussion question, a journal entry or calculation question, or a disclosure in your financial statement, right? So what I've done here is I've put together this table. If a cost is being expensed, it means it's going to our statement of profit or loss. If the cost is being capitalized, it's going to our statement of financial position. In order for you to determine which of these two columns it goes to, you must be able to identify and understand whether the cost falls under a research expense or a developmental cost. Okay, so if you look at 6.3, which is in chapter 6 on page 10, we have Taurus Limited, who manufactures video games and is currently busy with these 5 projects. So the table for each of the projects is given to us. And at the top, it has the capitalized development costs which were brought forward. And then we have our research and development costs for the year. So remember, we're seeing already at the top that this line is our capitalized development costs that are brought forward. So the first project is project 1, which is completed. Okay, so it's already completed. When something is completed or brought into use already, then you must immediately think that that's going to affect my amortization, right? Or I'm going to incur amortization because of this if it's a finite useful life asset. Now, the project's completed and commercial production commenced during the current reporting period. So they are already using the item. The directors are certain that the carrying amount of the capitalized costs will be covered through future sales of the product. Okay, sales of the product for the year amounted to 30,000 units, and estimates of future sales in units are then given to us, and it's estimated that no sales will take place after 2004. So to start off with, they gave us the brought forward capitalized amount of 600. Okay, so we know that we have a capitalized amount of 600. Then we know that because it's completed and they're already using the item, we need to then go and amortize this asset, right? Now, the method of amortization, just like depreciation, you choose the most relevant method of amortizing that asset. So in this case, they told us that the carrying amount of the capitalized costs will be covered through the sale of the product, okay? And there will be no sales after 2004. So in total, we have 30,000 sales from the current year, plus 40,000 from 2002, plus 50,000 from 2003, plus 60,000 from 2004. So our total expected sales is 180,000. At this point, we've already generated 30,000 of that total 180,000 of sales. So that is the portion that is recovered already, that we have utilized this asset for 30,000 units of sales already. So we're going to say 30,000 divided by 180,000 times our total carrying amount or our cost at this point, and it will give us our amortization for the period. Okay. Now, when we're recognizing amortization, we're going to debit our expenses in our statement of profit or loss, and we're going to decrease the value of the asset. Our capitalized amount is going to decrease by the amortization value. Then if we look at project 2, it tells us that 440,000 was brought forward as capitalized costs. Okay, got that. And then it tells us that research and development costs incurred during the year was 90,000. So initially this project was considered to be highly profitable, but as a result of the release of a similar Sony product, which is more advanced than this product, the success of the project is now considered to be remote. So all of these words, these big words like remote and, there's a release of the similar product and all of that indicates what to us? It indicates that the value of the project has decreased. And it tells us that the success of the project is unlikely. Okay, so during the year, they brought forward a balance of 440,000. They capitalized a further 90,000 to the asset. The project is not completed. It was considered to be highly probable, but it is not completed because of the release of the Sony product. So now we need to impair the cost of that asset. And how do we decrease it? We're going to say debit impairment loss in our statement of profit or loss and credit the value that we recognized in our statement of financial position. It doesn't belong there anymore because it is considered to be remote. A remote possibility means that it's unlikely that this product is going to be profitable. For project 3, they didn't bring forward any capitalized development costs. So what does that tell us? It tells us that at the beginning of this period, that project was actually not completed. Okay, so nothing. It was probably still sitting in the research phase since nothing was, we weren't able to capitalize any amount. So in previous years, 176,000 was initially recognized as an expense. Does it affect anything in our current year? No, because we expense expenses incurred as and when they are incurred. So it will go through the statement of profit or loss in those previous years. Due to the changes in market, the directors are now, after thorough market research, convinced that the project will in future earn income which will exceed the development cost, right? So now they think that this is going to be a very profitable project. And for this reason, the directors want to reverse the write-off. So that 176,000, the directors want to reverse it. So basically, remove the expense and put it to our asset, okay? But any amounts that have been expensed as and when they were incurred cannot later or cannot subsequently be moved to the asset. We cannot say we expensed it last year, but now we know this asset is going to be profitable, so let's go and capitalize that cost. That's not within our accounting principle, okay? So the only aspect to be capitalized is the research and development costs which were incurred during the year. The project at this point was still not completed, and if it was not brought into use, it means that we do not start amortization on it. Then with regards to project 4, similarly, there is no capitalized costs brought forward. We have incurred 181,000 of research and development costs during the year. Okay, so we capitalize that. And they tell us that the project satisfies the requirements for recognition of an intangible asset from 1 January and is estimated to continue for 3 years before the project is complete. So if it's not complete, it means it's not brought into use and there will be no amortization. And the last project, project 5, again, there's no capitalized costs brought forward. It tells us that there's 98,000 of research and development costs incurred during the year. So this project is new and the activities have been limited to research and the formulation of product alternatives by engineers, which you can see there's only salaries, directly attributable overheads, and raw materials which are used all in the research phase. So nothing will be able to be capitalized, right? So the 98 that was incurred in the research phase will go to our statement of profit or loss. This is a very basic example, but it should just help you to get an idea of what we mean by our differentiation between the research costs and the development costs. Okay, now at this point, we have covered the bulk of intangible assets, and we are moving on to ACCT311, which covers website costs. Now, website cost is very interlinked with intangible assets. It follows very similar, if not the same principles, concepts, and it should be easy for you to understand after you've gone through the research and development aspects, okay? But, you know, given the way things work in the world now and with how much of time you spend online, website costs is something that is quite topical. It's relevant for us, okay? So ACCT311 was drafted to specifically deal with the proper accounting treatment relating to the costs that are associated with the development of a website. Now, like I said, it's becoming increasingly important for businesses to create and maintain their own websites in order to compete for market share and also to promote their businesses and to promote their product. But the difficulty then comes in determining which costs can be capitalized and which costs can be expensed. Okay, so you can't just say, oh, this is my website, it's helping my company, it's bringing in money, it's an asset to me, and let's go and capitalize the entire website cost. Right. So let's say that your company operates an e-shop or an online shop, right? So via its website. Now, this e-shop is famous and it attracts a lot of customers. And there's also a section on this website with the company's blog, where they put up articles about the newest fashion trends. So they're not actually selling something, it's just the blog that's part of this website, the company. So this website, we can consider it an intangible asset because firstly, the company controls it. It has no physical substance. You can touch your computer screen, but you can't go physically touch a website, right? And it is identifiable. So a website can be sold off from the company. So, there's certain instances like, let me give you a basic example, how someone can create a following on a Facebook page or create a page with a lot of followers, built up a lot of followers on Instagram, and then they can say that, okay, they'll change this page name and they'll sell it off to you. You create it as your business page. You have all these existing followers already who you can sell to. Okay, so in terms of that, the website can similarly be separated from the company and sold out. If they have a lot of viewers, a lot of visitors to that website, somebody would actually pay money for that type of traffic to the online website. However, can you recognize the website as an asset? Okay, so if it brings in our future economic benefits, and if we're selling through it, it does bring in our future economic benefits, right? So this criteria will be met. So the same criteria that we went through under IAS 38 applies here to SIC 32, the website cost. The second criteria was, and remember from a few minutes ago, can you measure the cost reliably? So if it was developed by a third party, okay, they developed it for you and they sold it to you, then yes, you can measure the cost because you can measure what you paid to this third party. But if you developed this website internally, then very similar to the rules in IAS 38 about an internally generated intangible asset and the different phases and the particular criteria, SIC 32 website costs also have to follow this process of meeting certain criteria in order for it to be capitalized. Now, as mentioned earlier, there's 3 critical attributes that have to be met for any website to meet the definition of an intangible asset. We said that it needs to be identifiable, there needs to be control, and there needs to be future economic benefit. So together with these requirements, the recognition of IAS 38 has to be met in order to recognize an intangible asset for a website. So, is it probable that future economic benefits that are attributable to the website will flow to the entity? And can the cost of the website be measured reliably? And then after you go through that, SIC 32 identifies different stages of the website development. Now, the first one is our planning stage. So this stage is very similar in nature to the research phase that we went through under IAS 38. And any expenditure incurred in this stage, you already know it. It should be recognized as an expense when it is incurred. Then we have the application and infrastructure development. We have the graphic design development. We have the content development. So as you can tell, this is all our developmental phase. And any expenditure incurred in these stages should be included in the capitalized cost of a website. So as long as it directly relates to preparing the website and getting that website to its intended use, then these costs can be capitalized. And they include costs like our employee costs, our design costs, our license fees, and the cost to purchase content for the website, and all of that can be capitalized. Right. So we went through the planning stage, we went through our development stage. Then SIC 32 tells us that we have the operation phase. Now, operation means that it is in use. So the operating stage begins once the development is complete and the asset or the website is ready for its intended use. So the capitalization of the cost then ceases, and the expenditure incurred in the operation phase should be recognized as an expense when it's incurred. And the expenditure relating to the advertising and the promotion of the website and the promotion of the entity's own product are also recognized as an expense when they are incurred. Okay, now let's think a little bit out of the box about a few aspects like the purchasing, the developing, and the operating of the hardware of a website. So the cost of purchasing the servers and the internet, okay, getting an internet connection for that website to work, right? Getting the materials we need or the computer we're using to develop the website. Those things fall under property, plant, and equipment, not an intangible asset. So what about our internet service provider who hosts our website? Okay, now this expenditure is recognized as an expense as and when we use that internet service. So to summarize, ACCT32 relates directly or specifically to website, okay? And you have to follow the same definition and recognition criteria in IAS 38 together with the additional criteria that you'll find under the standard ACCT32, which basically differentiates between the planning or research phase and the different development phases. Costs can only be capitalized under the development phases, and you stop capitalizing as soon as the operation phase begins. Now, what's important is that in a scenario, we might not blatantly come out and say, this is the planning stage, this is the development stage, this is the operation stage. You must be able to identify that. If somebody is still studying, they haven't started building yet, they're just gathering research, reading articles about it, that's our planning stage, okay? If they're busy already working on developing the content, on designing the website, right? Then we can identify it and say, these costs will be capitalized because they fall under the development phase. Now, this brings us to closing off the topic on intangible assets and website costs, and it deals with the disclosure. So we've recognized the intangible asset. We know at what cost we've recognized it. We know how to measure it and account for an impairment or amortization if necessary, right? Now we have all this, we need to know how do we disclose it on the face of the financial statement. So IAS 38 tells us that for each intangible asset, we must disclose whether the useful life is indefinite or finite. And if it's finite, what is the useful life? What is the amortization rate? Okay, so all logical things that you need to know about the intangible asset needs to be answered. There'll obviously be an accounting policy note on intangible assets of a business, right? Because this is not standard across every business. You will need to tell us what is your useful life, whether it's finite, whether it's indefinite. Is it 3 years? Is it 5 years? Okay. What is the amortization method for the intangible asset? What was the gross carrying amount? What was the amortization or impairment losses? So basically like a recon. How do we get from the starting carrying amount to the carrying amount at the year end? Okay, so the line items that go to our statement of profit or loss, like our amortization and our impairment losses. Okay. All of this information you can find in paragraphs of the IAS 38 standard, but it's always advisable that you don't leave any studying to do whilst you're in your assessment, which means that you must already know what's in the standard. And in your assessment, only refer to it for guidance or if you need to copy out a principle or a definition quickly. Okay, but the understanding of it, you should already know offhand.